Hello, everybody. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Virus Turns, our housing market. Today is May the 7th. Hope everyone's doing well. I'm Randy Patrick, your host, putting the realism back in real estate. So hope everyone's doing well today. Lots on the go. As I said the other day, it seems like every minute, every hour, there's some interesting news about real estate going on in the marketplace, and we got to talk about it, and we're going to see what's going on. Today's Thursday the 7th, and we'll see what's happening right now. So most interesting news that came out is, I think, unemployment. We'll get into that in a second. And what I'm going to do, if you just give me a second here, I'm actually going to do the whole share screen thing here. So we have the ability to there we go, to actually sort of work through some of this, which is kind of nice, and at least gives us a little bit of guidelines as to what we're talking about. All right, so that's who we are, Housing Bubble 2.0. I'm Randy Patrick. I mentioned there's my contact information, so we'll go from here. All right, let's take a look at this right now. Here we go. Whoops, sorry, guys. And by the way, if you're not already a subscriber, please help my channel grow and subscribe. It'll certainly be most appreciated. All right, guys, here we go here. So what's the big news for today? Basically, 3.2 million workers filed unemployment claims last week. So obviously, we're a week behind in arrears, looking at the numbers, and another wave of layoffs caused by coronavirus. Basically, we peaked again. So ultimately, we had 3.2 million that filed last week. And where we are right now is we're looking at about 33 million, I guess you could say, people who are unemployed at this point in time, or not unemployed, who have filed unemployment claims, so jobless claims. That's where we're at this point in time. So as we've been talking about previously, there's more people that haven't filed. They can't file. They're getting to it. The sites aren't working. The sites are overwhelmed, etc. So we're still seeing these numbers increase. Now, obviously, analysts and economists are saying, "Oh, it's good news because the peak was the 6.9 million people during the 1 week period. A few weeks ago, we're only at 3.2 million this week." Well, that's great, but still that's 3.2 million people. So there's a significant number of people filing for unemployment here. And if we take a look at what Bloomberg's saying here, same thing going, jobless claims top 3 million, little relief in sight. We're looking at U.S. jobless claims past 33 million people right now. That's pretty intense. So if you look at that, you can see just in such a short period of time, we've had such a huge spike in jobless claims. If you go back to this chart, the earlier record was, looks like probably, one of the recessions that we had back in the 80s, and of 695,000 in 1 week. And here we are having, a couple of weeks of 6 million claims, everything basically over 1 million at least, some over 4 million. So a lot of stuff going on here. And this will cause some major issues that will affect the housing market. As simple as that. So that's what we're talking about today. Now, here's something a little more interesting. So you actually take a look at, deeper into this, and this is where I like to sort of get involved and to read a lot of news. So basically, here's an article that says, it's devastating. And the Minneapolis Fed President, Neil Kashkari, basically said that Friday's jobs report will likely underestimate or understate the real unemployment picture, as it will only reflect people who are likely actively looking for work. It's nearly an impossible task in a time of nationwide lockdowns, and that the country should steel itself for a long and gradual recovery. Basically, he said, the numbers on April look like unemployment rate of 16 or 17%, but the real number should be around 23 to 24%, adding that the situation we're in is just devastating. So we have somebody who's probably fairly knowledgeable about the economy, because he is basically the Minneapolis Fed President, and he's out there saying that, what's been reported probably isn't accurate. So if you think about it, if we're looking at 16, 17%, he's saying there's 6 or 7% on top of that. So that's a lot of people who are out of work or can't find work or actively looking for work. And that will have a massive, I guess you could say, domino effect on the economy, on housing, etc., on landlords, on everybody. Okay. Basically, we got the 7-week total is a staggering 33.48 million people have applied for, I guess you could say, unemployment insurance. There you go. Alrighty. To go on top of that, U.S. household debt reaches another record on home loans. And why I say that is the fact that, we just came off, what would be a decent quarter. Essentially, Americans increased their borrowing for the 23rd straight quarter to a total of 14.3 trillion, according to the Federal Reserve Bank of New York. The latest snapshot of household balance sheets entering what many believes to be a recession. So yes, there are people who still say we're not in a recession. I can't see how this is not a recession, or the fact that we're entering a recession. I know that some of the, I guess you could say, recession qualifications are having 2 quarters of negative GDP, but we know the first quarter we were down 4.8% in GDP. Clearly, we're going to be down more than that for the second quarter. So we're really in a recession right now. The crazy part of this record of home debt, and if you take a look at what's going on here, we've got a ton of student debt that's out there, and this chart actually nicely shows from Q1 of last year to Q1 of this year, shows the increase. So student debt was up, credit card debt was up, auto debt was up, other debt was up. Mortgage debt was actually up the most. It was almost up. I guess that would be half of, or almost, that's almost half $1 trillion. And home equity, funny enough, actually slid slightly. So we have more mortgage debt where we are in this quarter, or the first quarter, and we have a little less home equity. So we can see that there's a significant amount of, people are carrying a ton of debt. And we, as citizens of this country, as residents of this country, we're at the, it's almost like every quarter we're hitting a new record on debt. So clearly, we've got a lot on the go here, and that's why shutdowns, job losses, this and that's going to have a domino effect on every aspect of our lives, our financial lives, and ultimately, because we're concerned about housing, the housing market on this channel, and it's going to hit housing, obviously. So more and more mortgages were taken out over the past year, and a lot of people did refis, etc. And guess what? Equity stripping, pulling money out, or buying properties at peak prices with low money down, incentives and things like that. So that's going to hurt us down the road here. So please keep that in mind as we move forward. All right. So this article in the Washington Post, and the market says the housing market faces its next crisis in May as rent and mortgages do. So yeah, so here we are. We had May 1st on Friday, last week. So we're still a little bit early to get the statistics for the first week of forbearance and non-payments and things like that. That may come out tomorrow. It'll probably come out next week. So we'll keep our tabs on that. But really what it boils down to is that, again, if you already had problems in April, that's going to continue on to May. And if you lost your job or lost income or things in April, then basically you're going to have first time non-paying of mortgages and or rents for May as well. So it's going to be difficult. Ultimately, in the end, they're saying it's very tense out there. The tension could explode this week as mortgage and rental payments come due for millions of Americans who have lost their jobs as the coronavirus has shuttered the U.S. economy. Especially true for high-priced regions where the stimulus payment of $1,200 per adult for those making under $75K a year are unlikely to cover more than a month of rent or mortgage payments, if that. So that's the concern, is that you've lost your job, you've lost income, and whatever, if you get a check. Now, that's saying you get the check. I mean, it could take a while to get the check, number one. A lot of people haven't got it yet, but ultimately, in the end, that money may not cover what you owe, or other bills are going to have to be paid first. So that's the situation we're in. So we're going to see this is going to balloon. There'll be a lot more crisis here, and I think that's where it's going to go. Part of the article states, and I've got the links for this in the information section of the video, by the way, here, but part of the article is talking about the fact that, they don't see this as being the same as the last housing crisis. So what last housing crisis, we saw sort of everything kind of unfold over a multiple year sort of period of time. Now, granted, we didn't have the access to the timely information we do now. We basically have real-time information. We're watching this unfold in real time. So back then, 2008, we weren't seeing as much as the information as we are now. But it did take, it took, from 2008, 9, 10, 11, 12. So we kind of went down this gradual sort of slide to the trough till we hit the bottom. And, it affected a lot of people. 8 to 10 million people were in foreclosure, lost their homes, et cetera. So it was a bit of a mess. what they're saying right now. And again, it's too early right now. So if we're talking about statistics, we're going to talk about the stats that are available to us right now. And economists and analysts are making predictions based on what they have. And as I said, we're 6-7 weeks into this. We're a full month worth of non-payment of rent and mortgage with forbearance and all these rent, moratoriums and eviction moratoriums and stuff. So we're still too early to see how this is all going to shake out or see what the real numbers are going to be. But just some comments on this article were saying, hey, it's not going to be as bad as the last housing crisis, but still prediction easily 1.5 to 2 million homeowners could lose their homes to foreclosure because of the crisis. And that is fewer than during the last housing crisis, but 2 or 3 times existing foreclosure rates right now. So at a minimum, we're going to see 2 to 3 times foreclosure rates. I believe that's a complete underestimate. We're going to probably see much more than that. But at least when you take a look at what's going on in the marketplace, that's 2 million plus properties that will fall into the foreclosure process. That's going to help. If you think about it, that could help a lot of people buy cheaper properties and get homes that they can't otherwise get right now. So realize that, again, this is a low estimate. We're still too early on finding out what's going on with respect to the marketplace. All right. Now, one thing I do want to show you here, which I thought was really interesting, and that's why when we take a look at some of the stats that are going on right now, we're doing the best we can. So I'm sure that we're information's almost as timely. We're getting on a weekly basis. We're trying to figure out where this is going to go with the distressed properties, the foreclosures, the forbearance numbers, the whole bit. But I found this is part of an article with respect to bank rate. Okay, now. Figure about this. Over half of mortgage and auto borrowers fret about their ability to pay. So this is a survey. I put the link as well in the information section. This goes through a number of surveys they took a look at with respect to what people's perspectives are and their thoughts are, what's going on right now. And this one chart, this one part of the survey I found was highly interesting. Let's take a look at this. So this is a little chart about really about forbearance, if you think about it. So most Americans have not sought relief for mortgages. And if you think about it, we asked, have you tried to contact your home lender to seek payments? And I got to tell you, to me, there's certain things that I see and read and I go, this is a very telling piece of information, statistic, document, chart, whatever it is. This is one of those right now. So if you take a look at, the people they did survey, and they did this survey actually back in April 20 to 23, so a couple weeks ago. So out of all the people they surveyed, only 17% said that they contacted their lender and received payment relief. Only 17%. All right. The next little blurb is, yes, I contacted my lender, but received no payment relief. That was 10%. So 10% of respondents basically contacted their lender looking for discussion, relief opportunities on what to do with their mortgage, and they were told that they could not receive payment relief. All right, that's interesting. The next little chart part there is 8%. Yes, I contacted them, and my request is currently in progress. So out of that, there's going to be some that'll fall into the payment relief category, and some that won't. So that's this 8% value. So that's going to be split a little bit. The next is 5%. Yes, I tried, but was unable to reach someone or submit my request. Because what we got going on here is that when we have a situation like this, the lenders, the banks, the servicing companies, they're going to get a deluge. They're going to get hit so hard with calls coming into their call center. All right, that's going to be a really big issue. So people have been, the first few weeks of this forbearance, people were waiting on hold times, whatever. Now I know that according to some of the Mortgage Banker Association, the weekly numbers they put out, hold times and things like that have been going down on average. But still, 5%, wanted help, but guess what? It's like I didn't get through, so I'm in limbo. I don't have help as of yet. I don't know what's going to happen. That's 5% of the unknowns. But this last piece here, the biggest chunk of the blue is, no, I have not tried to contact my lender. Now, I kind of look at this as two ways. So could this mean that I don't need to contact my lender because everything is cool and I am going to pay my mortgage, as planned, and I don't have to seek relief? Or the fact that these are people saying I need some sort of relief, but I've yet to contact them. Now, I look at it going, we're probably going to see a bit of both in here, but that's 60%. So the majority of people have, from the survey, have not sought relief for their mortgages. Again, that 60% may have some caveats and some little, carve outs in there, but that's the majority of the people. So if we have estimated around 4.2 million people in the forbearance we'll call it category as of the end of April, it was 3.8 million the third week. We're waiting for stats to come out for the last week of April, but the estimates are about 4.2 mil. All right, then of course last Friday was May the 1st, so it's all going to start over with another wave. So when you take a look at this number, this is why when I always look at it going, it's underreporting and statistics are very difficult to get your hands on. So you have to do some extrapolation about this and think, okay, if we got 4.2 million estimated right now going on, and guess what? 10% didn't get any relief. All right, what does that mean? That means they're not going to pay or can't pay. They're going to be candidates for the pre-foreclosure, short sales foreclosure market. All right, 5% couldn't get through. 60% basically haven't even tried to contact their lender. So ultimately, when you take a look at that, the majority of people, the 10%, no relief, the 5% didn't get through, and whatever portion of the 60% that falls into that I need help category, that's why I think that we're going to see this 4.2 million forbearance number increase a lot more as time goes on. That's number one. And two, what we don't, and this is a stat that, you're not going to see this because the people who don't get payment relief, they're going to fall through the cracks. They're not going to pay their mortgage because they can't. They will fall into the foreclosure process. And that's where, that's almost like, we're not accounting for that, or we can't account for that. And that's, how part of the market will be affected, and we'll start dragging the market down. So what's the opportunity here? The opportunity here basically is to, start looking for these people who need help to either, buy their property. Some may have equity, some may not. Buy their property, get a good deal on the property, help them cash out with something, and they can move on. 2, do short sales, which means you're helping them stop the foreclosure, settling the debt, getting a place or doing an investment, making yourself some money, which is great. Or 3, buy the foreclosure auction, and you're getting, hopefully a decent price property there if you can swing that. So, that's the 3 things how this will sort of play out. Depends on how you want to participate, if you want to participate. But again, I just really feel that, I saw this, I'm going, okay, this is an interesting slide, because it sort of shows that, like, you can't, I guess we would be, remiss in thinking that everybody who needs a mortgage relief has got mortgage relief and has called for mortgage relief. Well, this shows that they haven't, and that's a very telling chart, very telling piece of information, and that's going to manifest itself starting in a couple of months. I can imagine that happening. I know where this is going to go, and we'll talk about that maybe in some subsequent trainings, possibly my Facebook Live stuff when we do that. Okay, alrighty. So this is interesting as well too. So we've spoken about, I guess you could say, Airbnb and the situation with Airbnb. Now, I've always sort of gone down to the hosting, super hosting area that, hey, these are people who either have mortgages on properties, number one, or 2, they are leasing properties, or they have a monthly rental agreement from a landlord, and that's going to affect them. So it's either going to affect the Airbnb host directly or the landlord of the Airbnb host. But you can take a look here that obviously Airbnb is having such a hard time. We've seen in previous charts the decline with respect to the bookings over the past few weeks, and now they're going, hey, we're going to lay off employees here. All right, 1,900 employees. So clearly they don't see this business picking up anytime soon. All right, I don't know what Airbnb's total employee count is, but that's a significant amount of people to be laid off. Ultimately, the CEO of Airbnb wrote and said, "We are collectively living through the most harrowing crisis of our lifetime. And as it began to unfold, global travel came to a standstill." Now, granted, 1,900 employees aren't probably just all based in the U.S. They're probably across the board here, but I'm sure there's enough. I think Airbnb is headquartered in the West Coast, so I'm sure there's a lot of people who are being affected by that right now. Airbnb's business has been hit hard, with revenue this year forecasted to be less than half of what we earned in 2019. So right away, half. That's the revenue forecast right now, let alone if it even gets worse. Okay, we know Airbnb business will fully recover. The changes it will undergo are not temporary or short-lived. Because of this, we need to make some fundamental changes to Airbnb by reducing the size of our workforce and a more focused business strategy. All right. So, and these guys are planning on going IPO. So clearly IPO didn't happen last year, so to happen this year, it's not going to happen this year whatsoever. So when you're seeing when they're predicting a 50% reduction in revenue, that's a significant amount of people that aren't booking, which means a significant amount of hosts that are having a hard time making ends meet on a monthly basis, and that's going to be cause for problems as well too. So there you go. So just wanted to make sure that, I know that some people have stated that maybe Airbnb got some bailout, etc. I'm not too sure how that actually worked, if they did, or whether the individual hosts are getting bailouts. But the point is, this is where we're at. And this is a segment of the industry that's going to cause, foreclosure filings, defaults, the fire sales, quick sales, whatever, to get out and recover what they can. And again, this is where things, this is how the market crash or the decline of real estate prices actually happen when we see stuff like this unfold. All right, that was the article right there. Again, everything is in the section if you want to look at the articles directly. All right, this came out the other day, yesterday, I forget. So, the first quarter obviously was the end of March 31st. So Adam Data Solutions puts out their, they have a quarterly U.S. equity and underwater report. So what they do is they basically take a look at all the homes across the board and say, how much equity do we have and which homes are underwater? So I always find this interesting, and the reason being because I still think that, it's almost like we're looking at a dichotomy in industry. We have a lot of places, a lot of homes that are highly, we should say tapped up in their equity, and then we still have many locations where 3.6 million homes are seriously underwater. So it just shows how the country can be split with respect to, hey, this market's fabulous, and this market over here is not doing that great. All right. And I can tell you that this seriously underwater home number, when they started calculating this back in the last housing crisis, that number has always decreased, as it should, and it makes sense. So whenever they say, oh, we lost, we sort of gained equity, the underwater numbers are getting less and less. Well, that should be happening with respect to them when the market appreciates. So, but still having 3.6 million homes seriously underwater, still a lot there. It's not like there's 500,000 or 1 million. That's still a significant amount of homes that are underwater. So let's talk about this right now. So they consider right now that there's 14.5 million residential properties across the board that are considered equity rich. And what we mean by equity rich is the loans or the financing secured by those properties make up 50% or less in the market value. So in theory, your home was worth $200 in the open market, $200,000, but your loan balances are less than $100,000. You see, so you've got more than 50% equity in the property, so you're considered equity rich by Adam Data Solutions. All right, so highest equity rich states. Clearly, if you take a look at some of these, guess what? Most of them are in the West Coast. California, 42.3% of the homes are equity rich. Hawaii at 39%. Vermont, 38.2%. Washington, 36.6%. And Oregon, 34%. Now, again, these are homes that have more than 50% of equity compared to their loans. Doesn't mean, there's also the segment that's between 1% equity and 49% equity that's not calculated or not talked about here. They're just showing the big numbers. All right, so that's the equity rich states. So you can clearly see that 4 out of the 5 are in the West Coast or Hawaii, and then one lone one on this side of the world is Vermont, which to me is interesting. I've never really been to Vermont, so I don't know what goes on up there. I know there's a lot of ski resorts and it's a nice place to live. So whether there's just higher priced homes or just it never could have been one of those states that was never really affected by the last housing crisis as well. So again, interesting. Now, on the other side, the lowest equity rich states are clearly Louisiana, Oklahoma, Illinois, Arkansas, and Alabama. So we've got sort of more southern states here that have the less equity rich across the board. Now let's go even further into this here. Back to the 3.6 million seriously underwater properties. So when we say seriously underwater, I want to be clear about that. So seriously underwater means the loan value is at least 25% greater than market value. So for example, your home may be worth $100,000 on the open market, but your loan value is $125,000 balance or higher. So really, you can't sell it. So if you sold it for $100,000 market value, that means you're going to have to bring the you have to pay off your loan. You're going to bring money to the table to pay off that loan, which most people aren't going to do that or don't have the funds to do that, okay, especially now. So these are, I guess you could say, people who are stuck in their homes, they're house poor, and for me, that's just potential short sales, distressed property sales, potential foreclosures sometime down the road. All right, that's where we're at with respect to that. So again, realize that there's a word there, seriously underwater, which means 25% greater than market value is the loan balance. All right. Now, if we take a look at that, same thing. So remember that there are many more properties still underwater. So what about that 0.1% to 24.99%? That's a number that's never really talked about in some of their high-level stats that they produce. Clearly, we'd have to buy the information to see what the numbers are. So don't think that there's 3.6 million homes that are underwater. There's more of those of the homes, more than 3.6 million that are underwater. There's 3.6 million that are seriously underwater with that 25% definition. So, but again, food for thought, all right? So let's take a look at some of the locations. So clearly, the underwater states that are having the hardest time are Louisiana, Mississippi, West Virginia, Iowa, and Arkansas. Again, Arkansas, obviously we know, and with respect to the equity, same with Louisiana. I look at maybe Louisiana, Mississippi may not have recovered from some of the past couple of disasters, flooding and hurricanes. That also has impacts in certain markets as well too. So I know that Louisiana and Mississippi are just sometimes lower income states as well. So it all kind of works together that you have these issues in some of these states. If we take a look at the overall report, so 60.7%, the 107 metro areas reported an increase in underwater properties in Q1 2020. All right. So basically, 60%, almost 61% of these 107 metros they look at actually had their underwater levels go up. So more homes fell in the underwater category, which kind of shows that maybe our overall, even though equity, we've hit more equity, but I think when you look at it as a percentage, there's probably, as we see a few states pushing the envelope, keeping the equity up high, and a lot of other locations are sort of waning and eroding some of their value. So please realize that. Concentration of underwater properties, I don't want to go too deep into it. So they break it down into areas over 500,000 people. We have certain zip codes that are concentrated, but the kind of highlights here: Youngstown, Ohio; Baton Rouge, or sort of like Red Stick, Louisiana; Scranton, Pennsylvania; Toledo, Ohio; Cleveland, Ohio; Philadelphia, Pennsylvania; St. Louis, Missouri; Chicago and Rockford, Illinois; Trenton and Camden, New Jersey; Milwaukee, Wisconsin. So those are some of the highlighted locations that either have higher concentration in the city or have high concentrations in specific zip codes of underwater properties. Now, when you look at this list, even though that there could be other locations across the country, what do you see? Well, you see, you got a few in Ohio. There's obviously issues going on there. A couple in Pennsylvania, and you got the New Jersey issue. Obviously, we've got the sort of Illinois issue. We know that we got a lot of problems in Illinois with people leaving the state and pensions and stuff like that, high taxes. So you're going to see that there's reasons why. Maybe the Ohio is manufacturing, or the kind of like the Rust Belt that's having issues. So when you start drilling down, these are all places that are having underwater properties, losing momentum for whatever reason. The past few years of having higher and higher home value appreciation hasn't helped a lot of these locations, and we're kind of stuck. So that's kind of where we're at on some of these locations. But again, realize that we're not seeing this. To me, this is just what's going on in real America right now. We're not seeing the spikes like we do in Vegas or parts of Florida or Phoenix or things like that, though that will happen as this virus sort of rolls out, as the more unemployment rolls out, as the foreclosures and forbearance rolls out. We're going to see other locations possibly pop on these lists as well. So that's the scoop, guys. Basically, one more to talk about. Interesting enough here that one important sector of the real estate business or real estate industry is back in business. It looks like the iBuyers are coming back in full force. And when I say that, really, it's with the coronavirus pandemic, first 4 states to issue stay-at-home orders, the so-called iBuyer marketing guys, companies quickly stopped purchasing homes in anticipation of major upheavals in the U.S. housing market. But now 2 of those companies are resuming operations. So OfferPad is out there, and OfferPad is a company that specializes in buying homes directly from sellers and then turning them around quickly to be resold. Said that it'll begin fielding offers from home buyers, sellers, and real estate agents again starting May 8th in more than 800 cities across the country. So OfferPad is jumping back in a big way. And you wonder, well, what do they see that we don't see, or what's their focus going to be? How do they see this playing out? Another iBuyer, Opendoor, which I talked about last video, said Monday that it'll begin buying and selling homes again. In doing so, the company is rolling out new features that seek to make the process as contactless as possible. So I know a lot of these 2 companies are probably thinking, going, okay, if you're a home seller, or you want to sell your home and you've either taken it off the MLS, multiple listing service, or you haven't put it on yet because of the fears of the virus and the sort of thought process going, how am I going to handle this? How are we going to do open houses and showings and virtual tours and all these things and closings? Like, it is somewhat problematic if you think about traditional real estate. Well, obviously, from the iBuyer perspective, this is not traditional real estate. This is more application-based, web-based. So clearly, a lot of these companies are deploying, we'll call it processes and things that can be done via app, via virtual, to make it easier to pick up the homes. So direct sales to Opendoor now only require a virtual interior home assessment rather than an in-person walkthrough, starting with Phoenix on May 4th and then Raleigh-Durham on May 11th. That's the 2 locations they're rolling out. So before, you'd put an offer into OfferPad, and then one of their reps, which typically is a real estate agent, would essentially show up at your door, and they do a walkthrough to go, okay, let's take, if you say your home was worth X, or that's what you want, and you think you've got $20,000 worth of repairs or upgrades, well, the real estate agent's going to walk through, and then they're going to take pictures, they're going to do some analysis and come back and say, hey, great, we appreciate, you're looking to sell. Here's what we think it's worth, and here's the things that we're going to have to do to improve the property, to put it back on the open market, and to make money. So that is part of the process of negotiating and probably nickel and diming with the homeowner. But they're not doing that now. They're going to basically probably have the homeowner run through with their camera phone and just do the whole routine and see what happens. So that's going to be interesting. We'll see how that goes. So again, there's more features and more services they're going to sort of, we'll say, deploy and implement to make life easier in this tough marketplace. Well, it's still a small percentage. Many cities have seen the share of homes sold to iBuyers double in the recent years, and the iBuying firms have spread to more cities nationwide. While these companies are growing, they do face some challenges for sure, and not just as a result of the coronavirus outbreak. Even before the pandemic, there were questions about the business model. So yeah, we've seen before that Zillow was showing that they were getting X number of homes, but they were losing $100,000 on average every home they bought. So they're buying the market share. What are they doing? Is it a good business model? Who knows? They've all struggled with profitability. These were cash burning businesses, and they were all starting to start up the ancillary revenue streams like mortgage and title operations to prove out that profitability. So yes, it's almost like the home acquisition is the loss leader. Work to make it turnkey, so when they bring in a buyer, we get the house, hey, we'll make it a little cheaper for you if you get our mortgages and you get our title company. So they're basically able to revenue stream on multiple sort of vertical buckets with respect to the housing. Funny enough, though, another iBuyer, Zillow Offers, has not yet resumed home buying operations. A spokesperson said they will monitor market signals and local health orders before they jump back in the game. So interesting stuff in the industry. Resuming operations is likely the first step for everybody here. The iBuyers need to prove their relevance in the real estate market, and you're not relevant to anybody if you're not buying houses, which I agree. So they're going to come back. It's just a matter of how quick, how heavy, how hard, what markets, how long they last. We don't know. But for me, it's kind of like, okay, what's going on here? Let's give it a little pause for thought. So typical iBuyer model is I buy at a discount from my homeowner, and then I sell it at a higher value and make the spread. So typically an appreciating market would seem to make sense here. So I don't know how they're looking at it, or what they're looking at, what their predictions are. We're not privy to that. Or are they jumping on going, the first wave of people that are going to contact us are going to be people who need to sell, have to sell, couldn't sell in the MLS or on the retail market, maybe they're going to vulture on this and pick up some awesome deals or some lower price deals. You never know. So I kind of think that's the latter is what they're going to do. They're going to put their foot in the water and say, okay, for those of you who couldn't sell or haven't listed their property, we have a viable alternative here to get rid of it. It's clean and simple for the homeowner and the seller, and then they buy a property maybe at a discount price. So we'll see how this plays out over the next little while. All right, that's it for today. Let me just want to say, whoops, before I jump the slide here. So, hey, want to say thanks for the time today. By the way, I'm starting to reach out to a lot of people now for the last couple of days, going through lots of emails, lots of texts, lots of Facebook inquiries. So as I mentioned, always, we're looking to buy and sell property. I've got the real estate company looking for off-market real estate investments. I've got that as well, too, covered with the off-market stuff. If you're looking for to learn the short sale business, because that's going to be a big business coming forward, contact me. I know we're doing a lot of people playing tag here, and I'm offering discounts now, Corona discounts, basically, to get people involved, because I think it's going to be a great opportunity going forward. And I've got the Never Pay Retail as well, too, which is more of an introduction to the real estate market, home buying, investing, things like that. So 4 options for you guys. So ready to jump on board. Send me an email if you'd like. We'll talk. Give me a call, whatever. So thank you once again. Thanks for the views, comments, likes. Please share the video with family and friends. And again, if you're not subscribed to my channel, please help it grow and help me out and subscribe. I really appreciate that. You can get a hold of me right here. Guess what? There's the information. So there's my email, randy@luxuryshortsales.com. Jump on board, give me a shout, and we'll see how we can help you and what we can do together. All right. So anyway, that's it for today. Let me go back over here and we'll kill this. All right, guys. All right. So again, thanks very much today. I'll look forward to probably speaking with you next week. I'll try and pull another Facebook Live training video Q&A session over the weekend. Look forward to seeing that advertised on the community section of the channel and Facebook as well too. Right. All right, guys. Take care, and we'll talk to you soon.